I want you to picture this. It's 1998 and you've just started investing. Everyone around you is losing their minds over the internet. New companies with ridiculous .com names show up every day. There is millions and suddenly everyone thinks that they are Warren Buffett. So you do what most people did back then. You load up on handful of internet stocks. And for 2 years, your portfolio only looks up. People start treating you like you cracked a secret code until the year 2000.
It's described as nothing short of breathtaking, a points drop never before seen on the US market. Closing bell might as well have been an alarm, so savage was the selling. In percentage terms, it had less impact than the crash of 87, but it still left traders and investors shell-shocked. And spare a thought for Bill Gates. The Wall Street collapse cost the world's richest man a mere $1.8 billion this week alone.
The Nasdaq collapsed 80%. Half of the .com companies disappeared. Even the richest man on the planet lost $2 billion. The irony? The internet was the future as we know today, just not at the prices that people were paying back then. But why is this important today? Because today the exact same energy is back and it's with AI. People are calling it the opportunity of a lifetime. Or maybe it's another version of the same story. Every generation thinks that their bubble is the one which will never pop. John Templeton had a line exactly for these moments. The 4 most expensive words in history are, "This time it's different." But is it? Before you panic or FOMO, I want to show you the 3 forces which are driving this AI mania and what all this means for you and me. I'll be talking about the 3 warning signals here. The first one is the Magnificent 7, the Mac 7, which is a pretty popular terminology which is used. It's Apple, it's Nvidia, it's Tesla, it's Microsoft, it's Meta, it's Google, and it's Amazon. All great companies who are doing something amazing in their own, fields. A lot of it, a lot of them are working with one another. We'll talk about that also in a bit, but these are amazing companies. But the problem is that just these 7 companies make 30% of the S&P 500. What this means is if you own S&P 500, you are already massively exposed to AI. And all these companies are in the arms race. They are no longer looking to create the best search engine or the best smartphone or the best EV vehicle. They're all fighting for dominance in artificial intelligence. And the scale of spending is unlike anything that we have ever seen. Just talking about these 7 companies, Tesla is investing $11 billion on autonomy and building robots. Apple is spending $14 billion on AI-first features, which includes their deal with Google Gemini to improve their Siri. Meta is investing $60 billion in data centers and metaverse and creating, different platforms like the Ray-Ban and the Oakley, the Meta glasses that they have. They're creating different generations for that. It's very fascinating. I actually own them and it's nothing like, I personally believe that it can replace phones, which is why I started, this by saying that Meta is not just looking to create the best social media anymore. They are looking to get into other things, and all these companies are trying to get one thing, which is to have dominance in AI. Google is investing $75 billion in rebuilding the search with AI. Microsoft is going to invest $80 billion in funding OpenAI and supercomputers. Amazon has pledged $100 billion for AWS to power everyone else's AI. And Nvidia, as we know, it designs and manufactures GPUs for everyone else. And all these companies in all are investing over $300 billion in 2026 alone. That's more than the GDP of a lot of countries. The spending is so massive that a lot of economists believe that this is the single largest reason why US has not gone into recession yet. And this investing is not going to stop in 2026. It's estimated that by 2030, there'll be over $3 trillion invested into the R&D of artificial intelligence by all the tech giants. That's how badly these companies want to win. But desperate times comes with desperate measures, and not just are we very much dependent on these companies and their revenues in the S&P 500. S&P 500 is 500 companies and these 7 companies is 30% of it, which is bizarre. So that is one risk that we have in the overall index. But the other risk that we have is these desperate times looking, leading to desperate measures where there's an entire money loop which is happening within the AI companies. What I mean by that is is, it's like an amazing diagram that Bloomberg came out last month, where Nvidia was in the center of it. And what's happening is OpenAI buys billions worth of Nvidia GPUs. So OpenAI bought a lot of Nvidia GPUs. In turn, Nvidia actually turns around and invests billions back into OpenAI. So they are buying the GPUs, and then Nvidia invests in OpenAI, and then another tech giant, which is Oracle, comes along the ride and it spends tens and billions of dollars on Nvidia chips, and then OpenAI quietly lands, a deal with AMD, and all this, combination is actually making a lot of economists very, very uncomfortable. And not only this, Microsoft invested $58 billion in OpenAI, and then OpenAI pays Microsoft to use their cloud. And then Nvidia agrees to invest over $100 billion in OpenAI. Every one of these companies is booking revenue. Every one of these companies seems like they are growing. And therefore, we see the stock prices going up and the valuations going up for each of these companies. Think of it this way. I am the investor who puts money into your lawn mowing company. I then sell you the lawnmower, and then you provide me the service of mowing my lawn. Nothing wrong with this. There are three different businesses which are making money here. One is the investor me, who is invested into your lawn mowing company. Then I actually am the manufacturer of the lawnmower who is selling the lawnmower to this company that I've invested in. And then you are a service provider who is providing me the service to mow my lawn. Now, all these companies can coexist, and the thing is that we are both making money off each other. Our valuations are going up, but the money is moving in a loop. It's moving in a circle. That's what is happening in the AI world right now. And we are not talking about lawnmowers. We are talking about trillions and trillions of dollars of valuations which are being moved by these decisions. And this is the reason why economists and very smart people are betting against AI. Which brings me to my third warning signal, which is the market sentiment, which is not that great. If you look at the fear index, it's at 9 right now. It was around 30s. It was around 50s, which is basically, there was greed in the market. But the fear index is at 9, which is a record low in the last, many, many years and months. And Michael Burry, for those of you who don't know, this actually made the news a few weeks ago. Michael Burry is the guy who shorted the housing market in 2008. He actually kind of predicted the housing market back then and made billions of dollars. The movie The Big Short was named after him. I think there was a book as well. I'm not very sure. At the same time, Warren Buffett is keeping a lot of he's actually selling a lot of stocks, and he has the record amount of cash kept with him, which is bizarre. $380 billion of cash stash that he has. And all these smart people, they know something that we don't know, or maybe everyone knows that it's in a bubble, but all these people are now betting against the market, especially Michael Burry, who actually is now putting bets against Nvidia and Palantir, and he thinks that in the next 1 year they're going to crash a lot, and he has bet $1 billion on that. And it makes sense. Some of these companies are actually priced very weirdly. For instance, Tesla is trading at luxury brand valuation while their margins are shrinking. Palantir is priced as if it's already won the AI defense race. Many mid-tier AI companies are carrying PE ratios which can only make sense if the revenue continues to grow in a straight line, which is not possible in real life. And everyone's favorite, OpenAI, is valued at $500 billion when their net revenue is only $12 billion in this last year. You really don't have to be an expert to know that all these valuations are just overpriced. And the other thing that I'm also worried about is that there are 30 million new investors that entered the market in the last 2 years, and that's because of the proximity to invest, the ease of investing with Wealthsimple, Questrade, all these Robinhood platforms which are available, where you can invest by just learning it in 2 minutes and investing the money in 2 minutes. You can do fractional shares, and all this would actually fuel into the fear, because when things go bad, there will be emotion that will take over. All these new investors would feel that they entered the market at the wrong time, and therefore they would want to sell and never enter back into the industry. And that is something that did not happen as much in 2008, because the proximity to investing was not as streamlined, and definitely did not happen during the dot-com crash, where you actually had to call the stockbrokers to book your shares, and that is just too easy right now. And therefore, if it's easy to buy, it's also easy to sell, and which is also one of my worries. And the market is actually worried that all these 30 million investors, they are not as sophisticated to stay in the game long term. Here's what Warren Buffett has to say about his cash position in the market right now.
Long-term trend is up. Nobody knows. And I certainly don't know. Greg doesn't know. Ajit doesn't know. Nobody knows what the market is going to do tomorrow, next week, next month. And nobody knows what business is going to do tomorrow, next week, or next month. But they spend all their time talking about it because it's easy to talk about. But it has no value. And every now and then you find something. And occasionally, very occasionally, but it'll happen again. I don't know when. It could be next week. It could be 5 years off, but it won't be 50 years off. We will be bombarded with offerings that we'll be glad we have the cash for. And it'd be a lot more fun if it would happen tomorrow, but it's very unlikely to happen tomorrow. Very, very unlikely to happen tomorrow. But it's not unlikely to happen in 5 years. And then the probabilities get higher as you go along.
So the big question that the market is trying to understand is this the dot-com bubble all over again? Unlike the dot-com companies, AI companies have actual utility, real users, real use cases. OpenAI may be valuated at $500 billion with a $12 billion revenue, but it also has daily active users of 700 million people. That's a real path to profit. But signs of a bubble are everywhere. Extreme valuations, circular revenue loop, national level geopolitical hype, resource constraints, companies burning billions before profits. So yes, it is a bubble. We just don't know whether we are at the start or very close to the peak. Now, I'm not a financial advisor, but here's what I'm doing with my money. The first one is I'm not selling anything. That's the most important thing. Now, it's not like I've not sold anything. I did sell my positions in Air Canada and some of the stocks that I don't really believe in now. I did buy them during COVID. I held them for 3 years. In the most bullish market, these stocks did not do well. I just sold those positions. They were very little portion of my portfolio. I'm just keeping that in cash. Apart from that, I'm not selling anything because if you look at my entire portfolio, which by the way, you can actually go to Blossom and look at my entire portfolio for free, you would see that none of my stocks that I hold or the positions that I hold, they are penny stocks. They are all something that I believe in long term. And even if there are certain companies that I don't, the positions in there are very, very little and they are very small bets that I have made. And I am not selling anything. And I feel that selling during an economic downturn, even if everything falls to about 80%, I'll still hold everything because I know and I've had experience. I've analyzed the data for the last 2 or 3 crashes that it almost always bounces back. It might take 2 to 3 years, but it always bounces back. The second thing that I'm doing is I'm continuing to invest. It's not like I won't invest just because I feel that there will be a crash next year or year after next. I'm not stopping my investing. I'll continue to invest, and like a lot of people know, I invest 1250 per week. Now you don't have to do these numbers if you can't, but I do that in my TFSA and non-registered accounts. I do $100 a day in RRSP. I also do $15 a day in Bitcoin, and I also do $5 a day in Ethereum. And I will talk about why I've done that, but I'm actually investing all of this in just one ETF right now, which is VFV. If you have been following me for a while, you know that I was splitting it, in India, in tech.to. There were different, things that I was doing. I was also doing about 8%, 8 to 12% of my portfolio into individual stocks, which were the Max 7. I'm not doing any of that, and that I will discuss in my fourth point here. But the second point is we need to continue to invest, and it should not be like you are stopping investing. I'll give you a simple stat here. If, let's say we are in 2008, 2007, 2008, 2009, and we invested $1,000 per month in S&P 500, and we started investing in 1996. Let's say you started investing in 1996, 30 years you invested, you would be worth about $1.5 million, and that will be an year-on-year return of 8.4%. And that is if you invest $1,000 every single month for so many years. Now, let's assume that you started investing at the peak of the market just before the 2008 crash that happened. You started investing in September of 2007. In 19 years, your worth will be about $733,000 and you'll return about 11%. And if you were an absolute maverick and you stopped investing at this moment and you started investing at the absolute bottom. You actually timed the bottom perfectly and you started investing in March of 2009, which was the bottom of the market. You will be invested for 17.5 years now. You will have about $635,000, but your return will only be marginally higher than 11.5%, and it will be a lot higher than the overall average of 30 years. So like you can see here, even if you invest at the peak of the market and you stay invested for 30 years and you continue to invest the same amount of money for a long time, the returns would not be very different because the market always recovers. And this, even though it was almost a 50, 60, 70% crash, like it's a blip in the overall trend if you see long term. The thing is that if we are early into this AI bubble and the AI bubble will actually get bigger, these prices that we are investing right now will actually look cheap. And if you are late and we are at the peak right now, if you invest consistently like the previous chart showed, your returns will actually be okay. You'll come out well, even though in the next 3-4 years it would seem like you are actually losing a lot. But if you look at 19, 20, 25, 30 years, you will come out almost the same if you started investing at the bottom versus at the peak. What's important is that you automate it, you do it weekly, monthly, the same amount, you do it consistently without selling anything. And in our last donation session, we actually nerded out on the data for the last 32 years, which is crazy. Like we looked at 32 years, we looked at daily investing, we looked at weekly, we looked at monthly, we even looked at annual investing, and whatever way we slice and dice the data, if you invest every single week, your returns will almost be the same, irrespective of what strategy you utilize in terms of frequency. So frequency does not matter. What matters is that we stay consistent, we stick to a frequency and we stay consistent and we invest for long term. We also nerded out and we actually did a very detailed, I'll actually show you. So if you look at here, there are different sheets that we have. We ran scenarios, we ran crash scenarios, if you were to do lump sum, if you were to double the investing. Let me just first show you how the dips happen. So let's say if you want to invest in the dip, a lot of people are talking about doubling down during the dip. And if you look at the last 32 years, which is about 1700 weeks, there have been 200 weeks where the dip has been between 2% to 5%. So, about 12% of the weeks, you have a 200, more than 2% dip and less than 5%. 5 to 10% is only 32 weeks. Then you have 10 to 15% where only 3 dips, and then 15 to 20% dips. There have been only 2 weeks that has happened, and it has never happened that in a given week, and that would be very extreme. In the given week, S&P dropped by over 20%. So if you add up all of this, it's almost like less than 15% of the times that we have seen a more than 2% dip. And that's the reason why dollar cost averaging always works, because the dips, even though it seems like we'll buy the dip and we'll get rich, it does not matter. We in fact tested it on 32 years of data. What I did was that I actually assumed that whenever the market drops, let's say there's a crash of 5-10%, I start investing $2,500 instead of $250 every week. So I double my investing, and I do that for the next 3-4 years because that's how long it takes to get back to the peak levels. I do that during the downturn, and I start doing, I continue to do that during the upturn, and then I stop doing that when I hit the peak again, let's say in 3-4 years. If you're thinking that 3-4 years is a long time, yes, in 2008 when the crash happened, before we hit the peak again, it was not until 2011, 2012 when we started getting the peak prices again. So it takes about 3 to 4 years, and even if I do that, my entire net worth will move by 6%. That's it. 5 to 6%. And I'm not saying that's less money. On a 5 million base, 5 to 6% is a lot of money. However, even after investing so much more money for an extended period of time, which a lot of people cannot do sustainably, even then, my net worth is only increasing by 5%. And that actually proves that if you stay consistent, if you invest the same amount every single month, irrespective of what happens, you buy double if the market reduced to half because you just buy more shares, then you will come out ahead when the market recovers. And the third thing that I'll do is increase income. Your income is the fuel for your investing. A second income stream or a promotion compounds faster than any index fund, which is exactly why I have been stacking cash and I've been concentrating on improving income all throughout 2024 and 2025. And I'm now in a position that I have 6 figures kept in my cash account. And this is after I've been investing the same amount of money every single week and every single day that I was investing last year as well. And the reason why I'm so hell-bent upon investing into into this crash. If it happens, if it doesn't, I don't know. But if it happens, I am hellbent upon investing into this crash. Is very simply put that this is probably going to be the only crash in my working life. Back in 2008, I was still in college. 1998, I was 10 years old. 2000, I was 12 years old. And right now is probably the only crash that I could ever invest in my working life, and I don't want to be sitting on the sidelines. I'm talking about pullbacks of 30 to 60%, even more in some of the companies, and I'm not going to invest all the six figures into the index because I've done the math. It does not work. Yes, I'll be doubling down on the index. Instead of investing 1250, whatever I'm investing, I'll probably double the amount of investing in the index during that crash for 3-4 years if I'm able to, if my income supports that. But this cash that I have, I'll be dropping it on 5 things: Amazon, Nvidia, Meta, Google, and Bitcoin. Because I believe that these 4 companies and Bitcoin is here to stay for the next many decades. These are wild bets. I would not recommend you to copy in any way. And even if I make these bets, my portfolio would not be more than 6. These companies would not make more than 6% of my portfolio. Not one company would make more than 6-7% of the portfolio. And I am in it for the long haul. If these bets work out, I can actually retire before 50. If they don't, I'm okay to work until 55 or 60. And I'm not talking about small corrections. I'm talking about buying Google at 150, buying Meta at 400. I'm talking about, buying, Bitcoin at $50,000. Like, those are the pullbacks that I'm talking about. If it never happens and if I never see those prices, so be it. I'll invest that $100,000 and diversify into real estate. That's something that I understand and I like doing. I'll probably do that. I'm just chopping and not doing that yet because I still have a high conviction that there will be a pullback, even though it might not be as much or even though it might not be next year, but there will be a pullback and I need to be ready with the cash. And if I'm wrong, that's where my rule 2 comes, where I continue to invest the same amount of money that I was investing for the last many months, and I continue to do that all throughout the bull run, even if it goes for the next 2 years. But all this is only possible with great incomes because this is all extra money that I have after I'm putting towards my lifestyle and putting towards my normal investing that I do every single week and every single. This is all extra money which is sitting idle because my income increased and my lifestyle did not catch up to that income. And the 4th one is diversification. If all my money is tied up into one theme, which is AI or tech or Bitcoin, I'm not comfortable with that. A lot of people know that I'm a huge fan of S&P 500 and invest in a ticker called VFV, which is investing in S&P 500, the 500 companies in Canada, but that is 33% tech. So 33% of that is made of tech companies, and I think 36% of it is made of tech companies. And I also invest in another ticker called tech.to, which is YTD, and that's the technology leaders, and that is almost 70%, the top 7 companies. So I'm doubling down on tech there. I have stopped doing all of that until last month. It does not mean that I'm not investing. All it means is I'm not investing or doubling down on the individual stocks. I was also buying Amazon, separately I was buying $25 every single week. Like the 1250 per week was just split into these max 7 companies. Like 10% of it was going towards that. About 40%, 50% was going towards, S&P 500, and about 30-40% was going towards tech.to. Just doubling down on tech. I've stopped doing all of that and I'm only investing all of this money into one ticker, which is VFV. And the reason why I've changed this strategy is because if the stock market crashes, I will have the opportunity to invest in the tech companies directly, the 4 companies that I talked about, plus Bitcoin, and all of that will make my portfolio very tech heavy anyways. And therefore, I've just decided to put everything into the index, which is S&P 500, just for now. And I'll reassess, how it pans out in the next 1 year or 2 years. I'm willing to wait for 2 years and do just this for the next 2 years if there's no crash that comes. So for now, I'm keeping it simple. I'm just investing the same amount of money that I was investing every single month, but I'm not diversifying it and doubling down on tech. I'm just doing one ticker, which is VFE. So to summarize, I'm not selling anything. I'll continue to invest weekly and daily. What if we are in the beginning of the market? A bull run, increase income. That's something that I've been continuing to do, and I continue to do that in my business. And I want to diversify, and I want to, that's why I'm doing only S&P 500, and I'll probably drop really big amounts into some of the tech companies that I really believe in. Bubbles are not the end of the world. They are moments of extreme opportunity. I hope you like this video. If you like this one, you'll also like this one where I turned $10,000 into $1 million business and how to do all of that starting with zero. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए bye bye.